In this video, we're going to be discussing chart patterns. Some of the objectives discussed include why patterns occur in financial markets and the process of recognizing and classifying bullish and bearish patterns. Whilst this is an introductory video to chart patterns, there is even more valuable information that can be interpreted from the chart patterns that isn't covered here, but will be in more detailed videos in a separate chart pattern series. To start to understand why chart patterns repeat throughout markets, it's important to grasp that financial markets are a product of mass human psychology and behavior. And because we're dealing with collective human psychology and emotions, the same patterns can repeat over and over again. There are some formations in price action that do repeat across all markets and on all time frames that have the tendency to lead to the same outcome. Patterns will not lead to the expected outcome 100% of the time, but they can be used to get an idea of what the market is more likely to do next. As with all areas of technical analysis, chart patterns deal in probabilities, not certainties. Most chart patterns have an intrinsic bullish or intrinsic bearish bias associated with them, which we can then use to anticipate the likely direction for the price after the pattern. Okay, so the first pattern we'll be looking at surrounds double, triple, and multiple bottoms. These patterns occur when the market makes more than one trough at the same price level. So for a double bottom, there will be two troughs forming at the same support level, and after the second trough, the market would start to rally. This is an intrinsically bullish pattern, which essentially means that price can be expected to rise after the completion of the pattern. So to walk this through simply, if we look here, the price falls, creates support at the first trough level, and rebounds, got a near-term peak, tests support at that same trough level again, and then rebounds and continues to rally. That is where our double bottom is occurring, and you would apply the same principle to a triple or even a multiple bottom setup. So here we've got a real example of a double bottom forming in the 3-day chart of pound sterling against the US currency pair, the US dollar currency pair rather. Now the pound here we can see rises after the first trough is made, but subsequently returns to test this support level. As you can see, the support holds and the price continues to rally on from there. So if we go to show the other side, double, triple, and multiple tops are the opposite of double, triple, and multiple bottoms. They occur when the market makes more than one peak at the same resistance level. A double bottom shows that on the second test of this particular level, the market is unable to overcome that resistance and the price is thus expected to fall further. Here's an example in context of double, triple, and multiple tops. This particular example is taken from a double top reversal occurring in the 3-day chart of the pound against the dollar currency pair. We can see after the second peak failed at the same resistance, the pattern indicated that a significant high was put in place, and what you would expect afterwards was a subsequent decrease in value. And if the market were to enter a downtrend, this level would be your key point of resistance. For a reversal, if the price breaks above there, then things turn around. Here's an example of a triple top occurring in the 3-day chart of Japan's Nikkei index. The third peak, as we can see the first, the second, and the third peak, the third one here, tested the resistance just before the market crash around the time of the global outbreak of COVID-19. Note that triple and multiple tops/bottoms are just the same as double tops/bottoms, except that they form with 3 or more peaks/troughs at the same price level. A bullish flag, as its name suggests, is an intrinsically bullish pattern. It is a continuation pattern, which means that it indicates a continuation of the trend, unlike the double tops and bottoms, which were reversal patterns. You can see here we've got our flagpole and we got the flag. This is the bullish flag. A bullish flag begins with a reasonably rapid rise in price, as shown by the flagpole, which is then formed, and then the market pulls back temporarily with a descending parallel trend channel, which is the flag that we have generated here. This means price oscillates between two descending trend lines that are parallel to each other, and it is shown here in the diagram. If the price breaks out of the channel to the upside, the prior uptrend is expected to continue. So here is an example of a bullish flag happening in gold prices. So from the lows that were established here, there is a rapid thrust upwards in price, forming the flagpole, and that's shown by here. And then the parallel channel is shown by the red lines that are in a parallel nature to each other. You see that the price breaks out of the channel and then goes up to the upside, and the uptrend continues as a subsequent result on the time frame we're using. A bearish flag is the same pattern, only inverted. It starts with a rapid decline in price, making the flagpole, which can be shown by this point here, which is then followed by an ascending parallel channel. You can see shown by here. If the price breaks out of the channel, it's likely that you'll see the prior downtrend expected to continue. Now let's get an example up real quick. Here is a real example of a bearish flag occurring in a 4-hourly chart of the Shanghai Composite Index. We can see that the price is trending here, and then you get a breakout at this point, but this breakout is to the downside, and the downtrend continues to new lows, as we can see by these 3 points here. Now we're going to look at a bullish pennant. Pennants are very similar to the flag patterns. The difference is that instead of a consolidation taking the form of a parallel channel, for pennants, the consolidation is a symmetrical channel, shown here. That's the symmetrical triangle rather, not a channel. A bullish pennant is when a symmetrical triangle occurs after the rise in price, and a symmetrical triangle is when the price oscillated between two converging trend lines, where one trend line is downward sloping and the other is upward sloping. We've got the top one here, downward sloping, the bottom one, upward sloping. Now, if the market breaks out of this triangle to the upside, your normal expectation is for the uptrend to continue. So it has an intrinsically bullish sign. That's the best thing that we should remember right now for a bullish pennant. Let's get a quick example. So we have a bullish pennant here occurring on the short-term 5-minute chart of the pound against the US dollar foreign exchange currency pair. So after this symmetrical triangle, there is a very bullish bar which is shown here, and that marks the beginning of an advance. One would look to go long on such a break. Now with the bearish pennant, this occurs when a rapid decline in price is followed by a symmetrical triangle. The price is then expected to fall further if price breaks out of the triangle to the downside. As we can see here, the price breaks out of the triangle and has a bearish outcome, hence the intrinsically bearish assumption. So let's get an example in context here. We've got an example of a bearish pennant occurring in the hourly chart of the euro against the Japanese yen. Now, again, we have a very strong bar, but this time it's breaking out of the triangle to the downside rather than the upside in the previous example. The downtrend then continues strongly after the triangle, which one could use this trading signal to generate some kind of return post the signal having a confirmation here. Okay, so an ascending triangle is a bullish formation. The triangle here, though, let's give a quick example, is different from the triangles in the pennant formations, because here the upper trend line is horizontal, not sloping downwards. So, price oscillates between the static resistance and a rising support line. We've got the static resistance there, shown by this point, and then we've got the rising support line. Price here is expected to break above the horizontal resistance eventually, and when it does, as you can see, the market is likely to rise further. So let's get an example here. We've got an example of a large ascending triangle on the S&P 500, which is an index I like to trade from time to time. And we can see throughout the triangle here, the oscillations in price get gradually smaller and smaller until it finally breaks out to the upside and the price rises further. A descending triangle is the reverse of an ascending triangle. It is a bearish pattern, and this time the triangle is made out of a horizontal support level and a descending resistance line. Let's show it here, the horizontal support level and the descending resistance line, which is shown here. Essentially what happens here is you're expected to see the price break out to the downside and then continue a decline. So let's use our example here. We've got an example of a descending triangle occurring in gold prices, and this accurately anticipates a subsequent decline in price after a downside breakout. You can see here the price breaks out to the downside and we see a fair bit of a drop in the gold price. So now we're going to look at a head and shoulders pattern, and this is a very common pattern as shown by the picture we put here. It occurs when we have a peak in price shown by the left shoulder, followed by a higher peak shown here by the head, followed by another lower peak shown by the right shoulder. It's essentially a bearish pattern, so you would expect the price to fall here, and a neckline here is drawn by connecting the troughs on either side of the head. But the pattern isn't complete until price falls below the neckline. You can see here, price falls below, you've got your head and shoulders pattern. You'd probably short this breakdown. You definitely wouldn't like to be long in this kind of a setup. And the neckline doesn't have to be horizontal. It can be inclined in some cases, but it's not super important in that case. Okay, so here's an example of a head and shoulders reversal in the US dollar Japanese yen foreign exchange pair, as shown here in an hourly chart. Now, after the right shoulder, we can see that the market breaks below the neckline, as shown by this red circle. You can see there's a neckline there by the dashed purple line. But that red circle shows that point where the neckline fails to hold support. Price breaks below, and we can see after this neckline break, the market rises up to test the neckline again before returning to decline properly. Now we're going to look at an inverse head and shoulders setup. This is obviously the inverted version of the standard head and shoulders, and as such, it is a bullish formation. It has a trough, a left shoulder, well, the trough here, which is the left shoulder, and then it's followed by the lower trough, which is the head here, and then it's followed by another higher trough shown by the right shoulder. That's probably the easiest way to show it. But this time the neckline is drawn by connecting the peaks on either side. These two peaks from here, either side of the head. And again, the neckline doesn't have to be horizontal, although a lot of the time it often is. So here's our example of an inverted head and shoulder setup on weekly gold prices. Now we have an inclined neckline here, shown by the red line that is rising. That's the inclined neckline. And after the right shoulder here, the price seems to be breaking out of the neckline, shown by that red circle. It breaks out and then briefly returns again to test that neckline as a bit of support. Then it rallies strongly from there. The next pattern we'll be looking at is called a rounding bottom. This is a bullish reversal formation, which occurs when support for the price traces out an upwards curve. It occurs after a decline in price, and being a reversal pattern, price is expected to rise after this rounding bottom occurs. You can see we've got that rounded bottom, and then we have the price rallying straight after. We'll now look at an example. This example we will pull up real quick. It is an example of a rounding bottom in one of the favorites many tend to trade, Tesla, and it's an hourly chart of Tesla stock. You can see instead of a rapid reversal, the downtrend transitions gradually into an uptrend by forming the rounding bottom here over a longer period of time. You can see the 28th of a given month onto the 4th of the next month. And the price here rises significantly after the rounding bottom has occurred. You can see the price rallies from around $248 to around $300 a share, which is a decent return for this kind of setup. Now if we have a look at a rounding top, This is of course the opposite of a rounding bottom, as we can see by the nature of the pattern. You can see the rounding formation occurs on this side, the top area, hence the name a rounding top. It occurs when the resistance for price peaks traces a downward arc. In an easy way, the curve here occurs at the top, and then the price follows back to the exact projection point, which is kind of here, and that's where you normally target. The price is essentially expected to fall from that point. So here is our example. In this situation, we have a rounding top reversal in a 15-minute chart of Boeing shares. Now you can see here the rounding formation, and the price reverses, and a downtrend ensues afterwards. With a cup and handle formation, it is a bullish reversal pattern that is similar to a rounding bottom, but we have that rounded area, and then we have a handle before the breakout. You've got the curved support here, as we just mentioned, and then a downward sloping parallel trend channel, which occurs forming the quote-unquote handle part of the pattern. Now that pattern, the handle area, is expected to be a minor pullback in part of a larger bullish move. So price is expected to break out of this channel to the upside and deliver some upwards movement. Here's an example now of a cup and handle pattern in weekly gold prices. We've got the cup formation here, and then we have the handle from these parallel, falling trend lines that form a channel. We can see that the price broke out of this handle area, as shown by the red circle here, and moved to the upside. There was actually also a later confirmation of a bullish breakout when the market broke above this prior resistance level here. You can see the price broke out, and it's shown by this grey dashed line with a strong bar. You can see price closes up here, and this secondary breakout could have been useful for a more conservative entry, waiting for additional confirmation, and then you'd be able to capitalize on the upside here, where you don't have a difficult area to generate a range. You can see the price breaks out above this prior resistance. You've got a decent bit of upside and a little amount of risk if you were to open a position here. A falling wedge is intrinsically a bullish chart pattern, as shown here. In it, the price oscillates between two converging trend lines. You can see they're converging, meaning they're getting closer together, and the price eventually breaks out. The difference here, however, is that when we compare triangles in pennant patterns and the wedge patterns, it is that for a wedge, both trend lines are moving in the same direction. For a falling wedge, both trend lines are pointing downwards, as we can see here. Both are pointing downwards. Now, this is although with the upper trend line pointing towards the downside at a steeper gradient. You can see this has a steeper gradient than this line here. For a pennant though, the trend lines will be pointing in opposite directions, one ascending and the other descending. Now in this situation, the price is expected to break out of the upper trend line of a falling wedge. So this is an intrinsically bullish pattern. Let's have an example here. So this example is of a falling wedge pattern occurring in the daily oil, sorry, not the oil prices. I saw CFDs and I thought oil, the daily gold prices we've got. And one thing you should probably notice here is after the breakout, the price came down to test the area of support just at that trend line level. So it came for a retest of the trend line before rallying properly. Now for the final pattern of this video, we're going to be looking at the rising wedge. In a rising wedge, which is intrinsically bearish, price oscillates between two rising trend lines, where the lower trend line is rising at a steeper gradient, so the lines are essentially converging. You can see they're getting closer together once again. Converging meaning getting close together, diverging meaning getting further away. Now, price here is expected to break out of the wedge and continue falling to the downside. Let's get a chart example to try and make a little bit of sense here. So here's a simple example again with gold prices, and we are looking at a daily chart. This leads to a resumption of an existing downtrend. At this point, one would look to go short on the break below this rising wedge and would look to reap the rewards of a continuation in the downtrend. So, we've covered 15 chart patterns in this video. This is a summary page which categorizes all of them into either bullish or bearish patterns. You can download this as a reference guide for free, and the link for that will be in the description of this video. One point I wanted to make was that we must remember that the market won't behave as expected according to these patterns 100% of the time, but they are good guidelines and generalizations that will work on charts of any asset on any time frame, whether you're looking at a 5-minute forex chart or a monthly equities chart. It really doesn't matter. It could be of somewhat value to you at the very minimum. To make chart pattern analysis more effective, you could try and combine it with other areas of technical analysis, so it will work particularly well where you can identify occasions when the intrinsic bullishness or bearishness of a pattern is reinforced by the extrinsic bias of where it occurs. So for instance, a double bottom will have a higher probability of triggering a new uptrend if it coincides with a long-term moving average support. This video today was only a brief introduction to chart patterns. There is so much more information that you can get from them that wasn't covered in this video, like how to obtain minimum expected price targets based on each pattern, how volume is expected to behave during the formation of each pattern, and the exact points where the patterns are confirmed or declared failed patterns. All these things will be covered in detail in our videos in the chart patterns series, so watch out for those.